The only thing guaranteed in life is death and taxes. And property taxes are no exception. If you own a property in the state of California or actually anywhere in the US, you will be paying property taxes. Now, of course, these property taxes vary from county to county, depending on where you live. And Santa Cruz property taxes happen to be higher than the national average. The national average is about 0.99% of your property tax base. Santa Cruz County property tax base averages to be about 1.26% of your property tax base. Now, the original or the initial property tax fee is based on 1%, and then things such as bonds, assessments, and measures, usually based on your voting ballot and what the citizens of an area vote in or out, become applied to your property tax basis. But what if there were some cool tricks to learn about that could potentially save you money in the long run? Would you be interested to hear more? I'm Shemeika Fox, your Santa Cruz real estate expert, and I'm really excited today to talk about property taxes, which strangely is not a very exciting subject in my own opinion. I don't love giving my money away. I'm sure nobody else does. But we're going to talk about property taxes, and we are also going to talk about potential ways of saving on your property taxes. So let's dive right in. So we just talked about the basis of our property taxes. We talked about bonds and measures that are applied to people's property tax base that actually increase our property taxes here in Santa Cruz County. Again, our base rate is 1%, and then bonds and measures are voted in on a regular basis, and then they are applied to our property tax bill. Question: do you think that if you don't own property in the area that you vote, you should be allowed to vote on a measure that will affect your property tax bill? I'm just curious. I want to hear from other people. I have my very own opinion, but I'm curious. Does everybody have a right to vote on something that they will not be financially obligated to pay for? I'm curious. Let's talk about a supplemental tax bill. A supplemental tax bill is a bill that will come when you purchase a property. It takes the Santa Cruz County Assessor's Office a little bit of time to catch up with newly recorded deeds of trust, noting that there's new ownership and noting that there is a new property tax base. Property tax bases are based on the sales or purchase price of your property here in Santa Cruz. Now, those can change if you are to remodel and change things on your property. Then you have the potential of having your property reassessed. So, a supplemental tax bill will come if you purchase a property in Santa Cruz County, the property was previously assessed at a different tax base based on the previous sale, and then it is reassessed at the new tax base. There will be an interim between when you purchase the property and when the assessor's office catches up to the newly recorded sales price, and you will initially be paying property taxes on the basis of the seller's property tax rate. Now, once the county catches up, they will notice that they had been charging you incorrectly, and so there will be the gap period that you have to pay back. So for example, we are in a county and our property tax base is approximately 1.26%. Let's say a tax base was initially based on a $500,000 property. You purchased the property for $1 million. You may pay property taxes at the $500,000 rate for a year before the county assessor's office catches up and realizes that the new sales price is based on $1 million. And so once they catch up, your supplemental tax bill will be due. And the supplemental tax bill will be the difference between that $500,000 base rate and $1 million base rate. Moving on from supplemental taxes. With the new Proposition 19 laws, and this is the part that gets kind of exciting and interesting because there are ways that you can actually save money on your property taxes. So with the new Proposition 19 laws, there's a couple things that I want you to be aware of. The first thing is if you inherit a property and you use this property as your primary residence, you do have the ability to utilize the property tax rate that was assessed on the property with the previous owner. So if your parents pass away and you're living on the property as your primary residence, then you can utilize the property tax rate that your parents were paying. It is not effective. You cannot use the property tax rate if you use this residence as either an income producing property or if you use it as a vacation home. It has to be your primary residence, and that is the new Proposition 19 rule. Another way that you can potentially save on your tax base is if you are downsizing. Now you can transfer your tax base anywhere in California to downsize in property. So that means that you're exchanging your property for like-kind property. So it has to be the same dollar amount that you sell your property for. You can purchase a new property, and if that property is the same amount, then you can transfer the same amount or less, you can transfer your tax rate. If you are purchasing a property that exceeds the sales price of your property that you are selling, then you would have to make up the difference. And in Santa Cruz County, it would be based on approximately 1.26%. So for example, let's say that you are selling a property out of the area to move to Santa Cruz County, and you're living in, let's just say Ukiah, because that's where I'm from. You live in Ukiah, you sell your property for $500,000, and even though you're quote unquote downsizing and moving to Santa Cruz, the new property that you're purchasing, the purchase price is $1.3 million, which is approximately our median sales price currently right here in the Santa Cruz County area. So you are going to have an excess or difference of $800,000. So you can transfer your property tax base for the first $500,000, and then you are going to have to make up the difference of that $800,000. Now, if you are selling a property in Santa Cruz and you are downsizing, then you should be able to transfer that property tax base. So let's say that your property that you are selling has a tax base based on $150,000 because you bought this house in the 70s. And even though you're buying a house now that is worth $1.3 million, you are selling your house that you bought for $170,000 in the 70s for $1.3 million. You would be able to take that $170,000 tax rate with you to your new property. And the same applies if you are selling a property and you are paying less for another property. You can take your tax base with you. So to recap, remember that there are supplemental taxes when you purchase a home. So don't spend all your extra money thinking that you're not going to have to pay the tax rate on your new property based on the new sales price. Save for that supplemental tax that will come in the mail. Number two, if you inherit a property now with Proposition 19 and you utilize it as your primary residence, you will have the ability to actually take advantage of the property tax rate that the person in which you have inherited the property from was at. If you, and this is a big if you, utilize the property as your primary residence. So no investment properties and no vacation homes. And the third thing that I want to remind you about that we just covered is if you are 55 and older now with the Proposition 19, you can transfer your property tax base anywhere in California if you are buying like-kind property. If you are upscaling, so your purchase price is more than your sales price, you will have to pay the difference. Well, this is a really fun and exciting one for me. I love talking about property taxes. I love talking about real estate, actually. So if you have any questions, please feel free to reach out. I'm Shemeika Fox, your Santa Cruz real estate expert. And as always, I'm here to help. Can we do that? Okay. I think there's a hair on me. Okay, I got it. And then things such as, and the supplemental tax bill will be the difference between that $500,000 base rate, $500,000 base rate, and then you are going to have to make up the difference of $800,000 so that you can, and then you are